As crude oil breaches 115 following the escalation in the Middle East, that inflation-proof portfolio you built is facing its first real stress test of 2026. We're breaking down why the Strait of Hormuz bottleneck matters more to your EMI than any corporate town hall ever will. Just when you thought the global economy was settling into a post-pandemic rhythm, the geopolitical engine has decided to backfire, sending Brent crude into a territory we haven't seen in years. This isn't just about the price at the pump, it's about the systemic ripples moving through the global supply chain, impacting everything from your quarterly bonus to the interest rate on your home loan.
Moving on to the catalyst of this surge, news reports from the last 24 hours indicate that maritime security in the Persian Gulf has reached a critical tipping point. With nearly 21 million barrels of oil passing through the Strait of Hormuz daily, roughly 21% of global consumption, any disruption acts as a direct tax on global growth. For the Indian professional, this is particularly poignant. India imports over 85% of its crude oil requirements. When global prices spike by 15% in a week, the fiscal deficit doesn't just expand on a spreadsheet. It begins to eat into the national budget for infrastructure and subsidies, eventually trickling down to the retail consumer.
In other news, the currency markets are reacting with predictable volatility. The Indian rupee is facing renewed pressure against a surging US dollar as investors flee to safe haven assets. A weaker rupee combined with higher oil prices creates a double whammy effect. Not only are we paying more for the oil in dollar terms, but we are also paying more for each of those dollars. This secondary inflationary pressure is precisely what keeps central bankers up at night, and it's why your expectations for a mid-year interest rate cut might need a serious reality check.
Turning our attention to the corporate sector, the impact on Nifty 50 and S&P 500 companies is becoming starkly visible. Companies in the paint, aviation, and logistics sectors are already reporting margin compression. While your firm's leadership might be talking about operational efficiencies and resilience, the math is simple. When input costs rise by double digits overnight, the bottom line shrinks. For the urban professional, this often translates to tightened HR budgets, delayed appraisals, and a sudden intense focus on cost optimization during those Monday morning stand-ups.
Furthermore, the U.S. Strategic Petroleum Reserve, or SPR, is currently at a decade-low level following previous efforts to stabilize prices. Reports from Washington suggest that the traditional buffer used to dampen oil shocks is significantly depleted. This leaves the global market without its usual safety net, making every headline regarding regional conflicts in the Levant or the Gulf far more potent. Without a strategic stockpile to release, the market is essentially trading on raw nerves and high-frequency algorithms, leading to the intraday swings that are currently bruising your equity holdings.
In the tech and energy transition space, this $115 oil shock is a grim reminder of our continued dependence on fossil fuels. Despite the aggressive push toward EVs and renewable energy grids, the old-world energy complex still dictates the cost of living. The cost of shipping a single container from Shanghai to Mumbai or Rotterdam has spiked as bunker fuel prices follow the crude trajectory. This logistics inflation ensures that the electronics, furniture, or professional gear you ordered online will likely see a price hike or a significant delivery delay as carriers implement emergency fuel surcharges.
Looking at the broader economic landscape, the threat of stagflation, the combination of stagnant growth and high inflation, is no longer a theoretical exercise for economics textbooks. It is a live risk. As energy costs drain discretionary income, the demand for high-end consumer goods and services, the very things many of us build our careers around, begins to soften. The wealth effect from your portfolio's growth over the last 2 years is effectively being neutralized by the rising cost of simply existing in a high-energy cost world.
To wrap up, the $115 oil shock is a sophisticated reminder that geography is destiny. Your portfolio isn't just a collection of tickers, it's a proxy for global stability. As the geopolitical heat intensifies, the strategy for the modern professional isn't just to buy the dip, but to understand the fundamental plumbing of the global economy. In an era of $115 oil, the most valuable asset isn't just capital, but the ability to decode the headlines before they hit your bank statement. Stay informed, stay diversified, and perhaps keep a closer eye on the map than the ticker.